I think the biggest thing is customer data.
Mm-hmm.
Have clean customer data that matches. Don't make the buyer or the banker have to figure out how to match up customer names and customer data. Yeah, fine. If you want to provide it on blinded for the first round, like I respect that. I respect your kind of proprietary and kind of sensitivity, but provide clean customer data because that's going to be one of the most important things.
Folks, today we're going to be looking at IT services financing from a lender's perspective. And to talk about it all, I have the perfect guest, Reed Van Gorden, head of origination at Deerpath Capital, one of the largest underwriters of debt financing to large MSPs in the US. Reed will talk about why private credit lenders like MSPs. What is the typical leverage and terms in an MSP transaction? How do lenders think about recurring versus reoccurring revenue? Why partnering with a sponsor is so important for a lender, and most importantly, what can MSP owners do today to secure better financing terms? We cover all of this and more, including Deerpath's lending model, how deals are underwritten, and what separates a financeable MSP from the rest. If you're thinking about growth, acquisitions, or an eventual exit, this is an episode you don't want to miss. Let's dive in. But first, let's get some housekeeping out of the way. My name is Madhur Duggar. I am a senior M&A advisor at Excendio Advisors, focused around MSPs and IT services. And this is my podcast series, M&A Insights. If you are interested in finding out more about how we are helping MSPs exit or grow inorganically, write to me at madhur@excendio.com, connect with me over LinkedIn, or visit our website, www.excendio.com. Let's get started.
Reed, welcome to my podcast. I really appreciate your doing this so early in the year.
Yeah, no, thank you very much, and thank you for having me. It's a good week to have it. All predictions at this point can still be true because
Right.
we're
I love
all
that.
7 days in, so anything can still be true at this point.
That's a great point. I also like the fact that we're finally talking about something that is so critical, I think, to a lot of the deals that are happening in our space, but we generally don't give it much airtime. So I'm glad we finally have you over here to talk about private credit. Tell us a little bit about your role at Deerpath and about Deerpath's, lending model, especially as it pertains to IT services.
Yeah, so as you said, my name is Reed Van Gorden. I lead the origination team, also one of the originators. So what that means is me and my team are calling on primarily private equity sponsors to source the deals to support them when they're buying a company, growing a company during their hold period. We focus on the market of 100 to 250 million of enterprise value, which is typically 10 to 25 million of EBITDA. Broadly speaking, IT services, and I know we'll talk about a few different IT services today, but IT services is either our largest or one of our largest, depends on a given quarter. Sectors in our portfolio, and that encompasses everything from IT MSPs to digital transformation to some of these businesses that are reselling technology or reselling subscriptions of, like an Atlassian or different technology solutions, as well as web development or just kind of people doing outsourced service, kind of helping people with their tech stack, kind of the full continuum.
Mm-hmm. Any recent transactions you can talk about that you'd like to talk about, or anything about them that you think you can talk about?
So one of the hard things, obviously, about our market is nothing really shows up in the Wall Street Journal because they're smaller deals. One deal, and I went back this morning to see what was kind of more publicly disclosed. There were kind of two deals over the last couple of years. One was this deal called DAS that was sold to Coalesce, which was an IT MSP, but a little broader than that. It did some kind of helping practice management, kind of more than just, let's call it your help desk, for kind of the healthcare sector. Coalesce bought it. We back that with the prior sponsor and then supported it with the new sponsor. Another one we had backed is a business that is now called Integris. That used to be called Domain. And now I believe is owned by Omers. But we're very active in kind of IT services. I think at this point for IT MSPs, I think we've done like 17 or 18 of them. IT kind of these, let's call it web develop. It's always hard. Web development, digital transformation, like where is the line? Sometimes can be a little bit hard, but in that kind of sector, we've done kind of 10 or so. And then we have 5 or so of kind of reselling VoIP, reselling internet, reselling different solutions. And then there's kind of a hodgepodge of different things, whether kind of reselling Atlassian, reselling some different software solution, reselling Salesforce and then implementing it, stuff like that. But it's been a very active sector for us, kind of in the portfolio, and overwhelmingly, the companies have performed very well.
Many buyers right now in our market are stretching themselves to find good assets. Finding scale, finding EBITDA is a challenge. I assume the reason why you're in the size bucket that you are in is because you get great scale and great business operational maturity both at the same time at that size level. Do you think that ever changes? Do you think this market ever gets to the point where people start going lower down in the size spectrum to do smaller deals and do lots of them?
So we do see sponsors increasingly coming down market, to your point, when they have a theme, when they realize IT MSP is a great example. They can't buy a $20 million EBITDA IT MSP. Exactly. 1, there just aren't enough of them. 2, they're too expensive. So if they want to buy one of those and grow the 20 million to 50 million of EBITDA, they might need to go start with 5 and cobble a whole bunch together. And we do see that. And that is a threat to Deerpath at times. The great thing about our market and our market position is we see so many deals. We see 2,000 deals a year. So if I lose out on a couple, that's not the end of my origination and the end of the world. But yes, over the last couple of years, it has become more prevalent to see bigger sponsors and then therefore bigger lenders, because the bigger lenders that you hear about all the time don't really actively play in my market. But if the bigger sponsor that they work with all the time comes down market, they will do the deal with that.
Why do you like IT services? What is it that makes it great?
Yeah, so they tend to have very strong revenue retention. And I want to separate here. There's recurring revenue and there's reoccurring revenue. And recurring revenue, I think of, and I think most of the market thinks about as an annual contract. And sometimes these can be multi-year contracts, but I'm not sure there's a big difference in business quality if it's a 5-year contract, a 2-year contract versus a 1-year contract, because ultimately what you're looking at is what is revenue retention, and that normalizes for how long the contract is. That tells you really all you need to know. But overwhelmingly, these businesses tend to have very strong revenue retention because customers don't want to switch out their IT provider, whether it is IT MSP. Why would you replace your help desk? Why would you replace your cybersecurity? Whether it's your firm rebuilding your apps or rebuilding your web, or rebuilding your hosting, why would you change it? Whatever it may be, why would you switch it out? 2, very strong industry growth that you're continuing to see strong demand. 3rd, good customer diversification. Every once in a while, that doesn't always happen, and you have to be a little careful there, because sometimes you'll get businesses that will have some customer concentration, and they tend to not churn. But what happens if that company's bought? Or what happens if that company really goes through a strategic change? That they're not just going to do it to do it, But if there's some real external factor, it may happen. And if that's a big customer, that could hurt your borrower or your business. Really, and then the fourth is healthy margin profile. Often 20%, like at least 15, sometimes as high as 25, and then very strong free cash flow. Every once in a while, maybe you have some capitalized software, but that's pretty de minimis, and most businesses don't have that. So you really have what the lenders are looking for, that you have very stable earnings, you have very diversified earnings, and you have very strong free cash flow generation. I guess the biggest negative at times is there might not be a ton of organic growth, depending on the industry, depending on the subsegment, where if you're doing kind of an outsourced service or a digital transformation, maybe there's a whole bunch of white space. But if you're in IT MSPs, there might not be a whole bunch of white space. If you're in cybersecurity, there might be a whole bunch. So that's a little hard to do over the whole sector, but that can be the negative at times in some of the subsectors, is you may have a really strong customer retention, but with that comes really low organic growth.
What do you think of as reoccurring, and how do you haircut it, or do you how do you treat it?
I think that comes down to what can you actually see in the numbers. So a key analysis for us is to get as much or as long of customer data as we can, and show one, the normal customer retention, kind of what is revenue retention gross, so including churn, but without upsells and downsells. Then include upsells and downsells. Hopefully after upsells and downsells, that net retention is higher than gross retention. Every once in a while it's not. And that is a negative. And then what is your customer retention as well? I think we used to do this analysis where we would then analyze, like, okay, let's only analyze the biggest customers.
Right.
We've increasingly stopped doing that, because when you do the revenue retention, you kind of normalize for all that, if that makes sense. When you analyze by the dollar, you kind of normalize for the size of the customer. And then the other big thing we do is, it's not always the top 10. Sometimes it's the top 20. Sometimes it's the top 50. It depends on how diversify their customer base, but look at those customers over as long of a time period as we can. And to be clear here, 2 years is not enough.
Not right.
Like ideally it's 5. At minimum it's 3 or 4. To have 2 years, which really means if you're doing retention is 1 year. That is not sufficient to come to a conclusion. And that will tell you on the reoccurring, is it higher quality or kind of lower quality. And some of that depends on the mix, right? If it's a IT service business doing like we have a company that does app development and like portal development for big companies. 1 year they're going to spend a little bit more, 1 year they're going to spend a little bit less, but I don't think they're going to stop updating that integral system. So that's going to continue. It's just a question of, is it up 20%? Is it down 20%? So that's a pretty high quality stream. There are other ones where maybe they're doing a new app for a new venture, or they're selling a piece of equipment in addition to the software, and they only sell that equipment every 3 years. That's a very different reliability kind of stream. And that's what that retention can really kind of show you.
Do you have, from an underwriting standpoint, hard lines? So for instance, from time to time I'll hear a lender saying, well, if the largest customer is more than 20% of revenue, we just draw a line there. We wouldn't lend to that.
Bigger than 20%, I would say, is just a pass. It's a simple answer. I would say recurring and non-recurring, that's hard. I think it depends on like in an IT MSP, if they're less than 60% recurring revenue, I think then I would say they're not an IT MSP, they're a VAR. And then therefore, frankly, their margins are probably sub 10%. So I don't think I would be interested. So I'm not sure there's clear lines there. I think it more is, okay, then I question just how much is their value add, and I would just pass because there's not enough value add, because I would say they're a value added reseller of really product, not a managed service business.
Yeah.
I think there are some project oriented digital transformation or implementation shops that have pretty weak customer retention because it's a one-time implementation of a software.
Yeah.
With minimal tails. But then you're betting on they're well known in the market and winning. And if they've been doing that for a long time, you can get comfortable.
Yeah.
Are you going to be doing that at the same leverage you're doing a very high quality IT MSP?
No.
Absolutely not.
Yep.
But I don't think that means that company is not financeable.
Yep. Does it matter who the buyer is? Have you lent directly to MSPs? You always partner up with a private equity firm?
Yeah.
And why?
So, I would say typically we focus on sponsor backed. I would say IT MSPs are one of the subsectors that we think are good enough quality, and we've done enough deals that we would do a direct deal, and we have done one direct with founders. But that's an exception versus the norm. And to be clear, even with the private equity firm, it matters. Like every private equity firm is not the same. So I think absolutely it does matter. I would also say one of the hardest things to diligence is the quality of management. Yes, you can look at historical, you can go meet them, but I do just fundamentally think that is one of the hardest things to diligence. But it is probably the most important.
Yeah, most important.
So I don't have a good answer there, but yes, I think the quality of management, the quality of the owner is of utmost importance.
Right. And I think your point there is, and the private equity investor is doing their due diligence on that, probably have a competitive advantage in doing that over you, which is why
and hopefully this private equity firm has known them for a long time.
Yeah.
Like I do think the market has evolved a lot where it is no longer, and I'm not sure it ever was, that a private equity firm just showed up to a banker process and it was the first time they met him.
Right.
The private equity firm has been following the company for a long time, has met him a couple times, has known him in the ecosystem. Just the same way we get to know the private equity firms. Like the first time I win a deal with a private equity firm is not the first time I met them.
Right. What is the typical leverage for a company that does 60% managed recurring revenues, is doing 15% EBITDA margin? So, from that standpoint, they're a healthy business. What are we talking about? Is it like a 5 turns leverage, 6 turns?
4.5 to 5 times. It depends a little on EBITDA.
Okay.
Size, I would say, kind of, let's call it 10 million of EBITDA, kind of probably high teens EBITDA margin. Kind of to your point, recurring revenue north of 60 is probably 5 times leverage. I don't think that necessarily goes for 15 times, but probably goes for 12 times EV. Yeah. I would say on the kind of more generic, like IT services, they all tend to be kind of 4 to 4.5. Every once in a while, something can be pushed north, kind of closer to 5, depending on the kind of customer data. But really, it's the customer data that spits out kind of where you fall in the leverage, because that normalizes for a lot of different things.
Yeah. And what is the nature of the loan? Is it tenor and like fixed floating and secured unsecured?
Yeah, so we are exclusively top of the capital structure, first lien, senior secured, floating rate. So based on SOFR. LIBOR no longer exists. It's now SOFR. They're in essence the same, but it's now SOFR. Floating, in essence, something based on Fed funds rate. plus a spread. And then term is 5 to 6 years, give or take.
Okay.
Some are 5, some are 6. That's somewhat negotiable. But today, I would say all-in cost of debt is kind of 9 to 10%.
Okay.
So if kind of base rate is kind of mid to high 3s, spread is kind of, let's call it 5 plus fees. So kind of in that 9 to 10%.
Do you originate to keep the loans on your books, or you originate to place?
So we originate to keep, and maybe just a couple minutes on kind of how we put everything together. So
Sure. Yeah.
We go out there and raise money from third-party investors. Think pension funds, insurance companies, high net worth, family offices, endowments, all your typical kind of groups of investors that you would hear about for private equity funds for the alternative investment landscape. They invest in us, into our fund. We then pool that capital and invest it into loans, and build a diversified pool for our investors, and then manage those loans on their behalf, and then return capital. We return interest kind of as we get it from our borrowers, and then return principal kind of after the reinvestment period is over for our funds. So whether 5 years or whatever the term may be, every fund's a little different depending on the investor need. Most of our funds or most of our deals, we keep and hold almost all, if not all. Every once in a while, the deal may become too big for us. And in that case, we'll look to bring in a partner. That's increasingly become a bigger part of our business because more private equity sponsors are doing add-ons.
Yeah.
One, that's become a bigger part of the market because multiples are higher at entry, so they have to buy down their multiple. 2, hold sizes have elongated, or hold lengths have elongated, so now they're just more add-ons just because time's longer. And that means we're getting closer or kind of going above our hold size limitations. So we are bringing in third-party lenders more often. But the aim is to hold the majority, if not all, in our own managed funds, because ultimately that's how we as the manager make money, is earning kind of the fees on the invested capital.
Reed, when you do the add-on, so in this example with the add-on, you obviously had the first slug of debt to the guy who did the platform, and the second slug of debt comes along. Does it sit pari passu with you, or does it sit junior to you?
It always sits pari. So if we're providing it, it always sits pari. It's in the same tranche, in the same security, governed by the same document. I guess every once in a while, if there's a performance issue or if there's not enough leverage capacity to borrow in my security, they may go find a third-party lender if they don't want to put in equity to do mezz or do subordinated. But that's pretty rare.
That's rare, yeah. And then I'm assuming that second loan is securitized, is collateralized by the combined cash flows of the entire platform. Right. Got it. Yeah. Okay.
Which is why we like add-ons, because you're growing the business. You're
That's right. You're adding
the collateral.
You're adding scale. You're reducing.
You're adding
the risk.
scale. Like we're typically not investing in a risky business, but by adding something else, you're typically improving it in some way.
Yeah. Agreed. Makes sense. Walk us a little bit through the loan underwriting process from when you first receive a request to your final lending offer, and just sort of how much time that takes as well.
Yeah. So the simple answer is we can run as fast as needed for a sponsor or for a process. We are never kind of the gating item. That being said, what is normal in our market is kind of 60 to 90 days.
Okay.
Because that's kind of how our processes work. And by that, I mean, we see about 2,000 deals a year. That's a deal comes in from to us, primarily from a private equity firm. At times, sometimes from an investment banker, while they're going out to private equity firms at the same time.
Okay.
And they may send it to us and say, what do you think about this deal? Do you like it? I'll introduce you to sponsors as they're bidding if you like it. Of those, about 300 go to investment committee. So about 15% go to investment committee. The rest, I wouldn't say all are desk killed. A lot don't meet our threshold for some reason. Maybe there's customer concentration we talked about. Maybe there's a really short operating history. Maybe they've only been around 5 years. We want a business that's been long-standing, has proved it is diversified, built a tenured management team, built a brand, built a presence, is well-known, is respected, is defensive. We don't want something that's just kind of fly-by-night operation, just been around a couple of years. So if it has a short operating history, it's not going to be for us. Maybe it has really volatile earnings. That's not going to be for us.
Right.
So there's a lot of reasons it doesn't make it to that first stage. Another common reason is it just doesn't progress with one of our sponsors. Maybe our sponsors don't like it.
Yeah.
Maybe there's some other sponsor that buys it that we don't cover as well as we should, or the deal never gets done. So it's not 100% on us, just to be clear.
Yeah.
But ultimately, about 300 deals go to investment committee. Of those, approximately 200, so about 2/3 get approved.
Okay.
Where we say we like the deal, let's try to go win it. Of those, we close about 100.
Okay.
The time between approving and closing is normally 30 to 60 days.
Okay.
And during that time, we're completing all of our diligence, meeting management, doing any third-party work we need to do, doing any industry work we need to do, doing any legal work, doing all of our legal documentation, whatever needs to be done in conjunction with the sponsor. In order to screen, we've done a fair amount of work to begin with.
Right. Yeah.
Because what I don't want to do is have something that I knew 2 months ago be the reason I pass at final approval.
Right.
That's not acceptable, to be honest. But if something comes up in diligence, if earnings are a lot weaker, or there's a background check issue, or there's some real issue, that is something that we will discuss and have to make a decision on. Ultimately, then we close the portfolio, the company, and it moves to our portfolio. And at a given time, we have kind of 150 portfolio companies in our portfolio that we're actively monitoring. And those companies are doing upsizes every year, as we've talked about, doing add-ons, et cetera.
Yeah.
So it's a very active kind of funnel with a lot of touches and a lot of visibility, which is one of the things we can offer to our sponsor clients, because we see a lot of deals. And when they call us on one, we can help them compare and contrast that to other deals we've seen in the market, other deals we may have in our portfolio.
What are things MSPs can do today? I know they can already glean a bunch of this from the responses you've already provided, but a few things MSPs can do today to help ensure they get your best terms.
Yeah, one of the new terms I heard this year was a data cube, which I'm still not sure I can really define. But I think the biggest thing is customer data. Have clean customer data that matches. Don't make the buyer or the banker have to figure out how to match up customer names and customer data. Fine. If you want to provide it blinded for the first round, like I respect that. I respect your kind of proprietary and kind of sensitivity. But provide clean customer data, because that's going to be one of the most important things. Yes, obviously financials are going to be important, but hopefully if you've hired a banker or you're running a process, your financials should be in decent kind of order.
Yeah.
But I think that customer data is very important. Another thing increasingly is data on like producer concentration and salesperson concentration.
Okay.
And understanding how those relationships work. And like a good example would be your consulting business. In the consulting business, it may show, and we've seen this, 2 people control all the relationships if you look in your CRM.
Right.
I don't think that's the way you would think of it. But if you do a CRM export, that may be the way it shows to people.
Right.
And if that's not the way it is in reality, I think it's in your best interest to make sure you've cleaned up your data to show it correctly or to show it appropriately. Because some of it may just be legacy coding. That
100%.
this was the founder of the business, and this customer has been with the business for 15
Right.
years, and they brought him
Right.
in 15 years ago.
Yeah.
And now the founder hasn't talked to this customer in 12 years.
That's a great example, because like that literally happens so many times with these businesses. 100%.
And then we have to then piece it apart,
right,
and explain it to our investment committee of, is that a risk or not?
Right.
And sometimes it is, and sometimes it's not.
Yeah.
But I think it's that, and then typically you don't have vendor concentration, but if you do, you should understand that. But typically you don't. But I think the biggest thing is customer
data. Yeah.
And maybe for some businesses it's the producer or kind of salesperson. And then I guess the new thing is just a discussion of AI, because everyone's going to ask. Everyone's going to ask, and I would hope you have some opinion or trial or something.
Yeah. Let's take just a big step back. I want to talk a little bit about, your views on the health of the private credit market. I mean, there's been conversation out there in the media is that we're in the later stages of a lending cycle, and that there might be a pullback either in equity markets or in lending. How do you think about the health of the private credit lending that's happening in the U.S.? Are you concerned? What are your thoughts?
It is definitely very aggressive today and borrower favorable, which, to your point, would indicate at some point it has to revert to the mean and has to revert to less favorable conditions. I don't know when. We've been saying it's been aggressive for a year now.
Right.
It hasn't really gotten more aggressive.
It just stayed that way. Yeah.
It's kind of stayed that way. It hasn't really gone. I mean, some markets in the upper markets maybe gone a hair more aggressive, but it hasn't really ticked down. I think if there's a whole bunch of volatility because of real concern about the economy and fundamentals, that would lead to a credit pullback.
Yep.
If it's because of just news, I don't know, I guess. It feels like we've kind of stopped paying attention to the news and how we go about doing deals and making investment decisions, but you never know.
Yeah.
I think to the extent you see credit defaults and the economy slipping, kind of to the earlier point, yes, absolutely things change. But all the economic data looks pretty healthy.
Reed, thank you so much for your time. Really appreciate it.
Thank you for
the insights, and hope to stay in touch with you. And let's keep talking about that conference opportunity as well. Would love to have you on a panel.
Yeah. No, thank you very much for including me.
Thanks, Reed.
Thank you so much, guys.